What is liquidity? And should you be willing to pay for it? And if so, how much? In this lecture, we'll explore these questions. We'll do this in 4 steps. First, we'll examine exactly what financial economists mean by liquidity. Second, we'll examine the things that determine whether or not the market for a particular security is liquid or not. Third, we'll examine how to measure the liquidity of a security. And then fourth, we'll discuss how you should think about whether you should be willing to pay the market price for liquidity. Okay, so let's start by defining liquidity. Liquidity is typically defined in 2 dimensions, the time dimension and the price dimension. A liquid security is one that can be turned into cash, i.e. liquidated, very quickly and without having the price fall significantly. If keeping the price fixed, it takes a long time to find a buyer at that price, that security is not very liquid. And if keeping the time over which you must liquidate fixed, you have to drop the price by a lot to get a buyer, then the security is also not very liquid. Housing is very illiquid. Shares of Procter & Gamble, very liquid. For most individual investors, the market for corporate bonds is not liquid. It is difficult to find active prices for bonds. This is also true for many foreign securities in the United States. Yet these securities are potentially the types of securities that you would actually want to invest in because they allow you to earn a very good rate of return given that the prices are so discounted in the market. Over time, the liquidity of most securities has increased. In fact, for many stocks traded on organized exchanges, you can sell a stock in seconds while only pushing the average transaction price down a penny. So why might you care about liquidity? For one, many less well-known stocks may be less liquid. But because they are less well-known, they're more likely to be mispriced, thus presenting potential trade opportunities for you. So let's say that you want to buy such a stock as a short-term investment because you think it's mispriced. You do think that the price will get to be appropriate level fairly soon, however, so you buy it anticipating that you will be able to sell it in the future for a gain. You need to recognize that your gain will depend heavily on the stock's liquidity. To see this, let's consider 2 stocks that you think are equally undervalued. Specifically, you expect that both will go from $100 to say $110 in a month. While both securities have the same values, let security A, a fairly well-known firm, have a 0.5% liquidity cost, and let security B, a more obscure firm, have a 1% liquidity cost. Now, what do I mean by a liquidity cost? What I mean by a liquidity cost is the amount your trade pushes the price up or down. We'll see exactly how this happens later, and we'll also look at why such a cost might be high or low for certain securities. For now, let's just take the liquidity cost as given for these 2 firms. With a liquidity cost of 0.5%, if you want to buy A, you will have to pay 0.5% over its current value when you buy. And when you go to sell A, you'll have to sell it at 0.5% below its value at that point in time. More specifically, you will go to buy A and you'll have to pay what? $100 times 1 plus 0.5%. So you're going to have to pay $100 plus 50 cents. And then when you go to sell A in a month or so, after its fundamental value has been recognized and it's risen to, 110, you're only going to be able to get, 110 times 1 minus 0.5%, that's $109.45. So your effective return in this case is going to be $109.45 minus 150 cents, all of that divided by $100.50. That equals an 8.9% return. Now, if you were to trade B instead, then what would you pay? You'd pay 100 times 1 plus the liquidity cost of 1%, you'd pay $101. And you would sell it for 110 times 1 minus the liquidity cost of 1%, you'd sell it for $108.90 for a return of only 7.8%. An alternative way to think about what just happened here is that to get the same return for security A, the change in the value, get the same return as you got for security A, then it would have to be the case that the value of B has to rise in terms of its fundamental value 11.1%. Thus, if you trade in illiquid stocks, you're going to have to work harder to find bigger mispricings. And if you churn your investments, the greater the liquidity cost, the smaller your realized return will be. Now let's turn to how liquidity costs manifest themselves in the market. In exchanges, there are two forms of transactions costs. One is the bid-ask spread, and the other one is brokerage fees. The brokerage fee is what you pay a broker to execute your trade. Brokerage fees are small and are getting smaller. Most any online broker will charge about $10 per transaction, while many are competing to be charging only $5 to $6. If you have a trade that's for 100 shares of a $50 stock, that's on the order of 1 to 0.2% in terms of the brokerage cost. The second cost is the bid-ask spread. Let's see what a bid-ask spread is. At any point in time, there are two prices for any security. If you, as the investor, want to buy, you will pay the ask price. If you, as the investor, want to sell, you will have to sell at the bid price. The ask price you pay when buying is always above the bid price you get when selling. The difference between the bid and the ask is the bid-ask spread. At any given time, the bid and the ask prices bracket the market's best guess at the fundamental value of that security. Thus, if you buy at the ask, you have to pay above the fundamental value. And if you sell at the bid, you'll get less than that fundamental value. So who determines the bid-ask spread? Well, at any point in time, there are actually lots of prices being offered or bid at in the market for any particular security. These prices come from limit orders. A limit order is a price contingent order that specifies the price at which the person who submitted the order is willing to trade. There are limit orders to sell and limit orders to buy. Let's see how this works by imagining that you are submitting a limit order. By the way, you can easily submit limit orders via online trade platforms. Let's say that you are also a buyer. If you're a buyer, you want to pay a low price. Thus, if you were to submit a limit order to buy at $20 per share, then your order will only get filled if the price is $20 or less. In contrast, if you place a limit order to sell at $20, your order is filled only if someone is willing to pay you $20 or more. In addition to the price contingency, you also have to specify the number of shares that you are willing to trade. At any point in time, there will be a set of limit orders that have contingencies that no one is willing to satisfy. For example, someone may have placed a limit order to buy at 2 cents for a stock that typically trades around $100. Of course, this person is willing to buy at 2 cents or less. But as we'll see, right, this type of order is not going to get filled. In fact, most limit orders actually trade very close to what I would say is the fundamental value of the security. So something like this 2 cent order, these are referred to as stub orders, and they're kind of just sort of silly, actually. This set of unfilled orders at any point in time determines what is referred to as the limit order book. To see what this book might look like, consider 4 possible limit orders, each placed by a different dealer, say. By the way, dealers place these limit orders in order to provide liquidity. We'll return to this shortly. Okay? So now let's say that dealer A placed a limit order to buy at $20 for 100 shares. And then dealer B placed a limit order to buy 100 shares at $10. Dealer B wants to get a really good deal. Let's say dealer Y placed a limit order to sell 100 shares at $19, and dealer Z placed a limit order to sell 100 at $25. Now, since dealer A is willing to buy for $20 or less, and dealer Y is willing to sell for $19 or more, there's a deal. Let's just say that they split the difference and the trade is at $19.50. They're both happy. Now, since these orders get filled, they're no longer present in the market. What remains is a limit order to buy from dealer B for $10 and a limit order to sell from dealer Z for $25. Dealer B will buy at prices $10 or below, but dealer Z will only sell if the price is $25 or higher. So there's no deal between these two dealers. Now, these orders will remain on the book unfilled until perhaps new orders come. So once all of the mutually beneficial trades have been cleared out of the book, the limit order book, what remains is a set of limit buys and limit sells. The set of limit sells are the current set of ask or offer prices. These are the prices at which someone, mostly securities dealers, are willing to sell the security. That is, they are the prices that dealers are asking buyers to pay. They're also called offer prices, as these are the prices at which they are offering to sell. The unfilled buy orders that remain constitute the set of bid prices. These are the prices at which various dealers are willing to buy the security. They are bid prices because these are the prices that dealers are bidding. Among the set of bid and ask prices, there is a best ask, which is the lowest possible ask. It is the best from the perspective of someone wanting to buy. The lower the ask price, the lower the price the buyer has to pay the dealer who is posting that ask. Similarly, at any point in time, there is also a best, i.e. highest, bid price. The difference between the best ask and the best bid is the bid-ask spread. Recall that the highest bid and the lowest ask will bracket the market's best guess at the fundamental value of the security at that time. Limit orders are typically placed by dealers trying to take advantage of a temporary lack of either supply or demand at a specific point in time. For example, if there is little supply but an investor wants to buy, then a dealer who placed a limit order to sell with a very high price will likely get to sell to the buyer at that high price. Similarly, if there's little demand and an investor wants to sell, then a low limit order to buy will allow a dealer to get a good deal on that transaction. Many dealers place limit orders on both sides of the market, by the way. Now, an alternative to a limit order is called a market order. Such orders are submitted by investors either wanting to invest in a security or wanting to liquidate an existing position in the security. Such an order simply says that they are willing to transact, either buy or sell, at whatever the going price is. That is, it is not an order that specifies a particular price contingency as does with a limit order. If you place a market order, your order is filled at the highest available bid if you are selling and at the lowest available ask if you're buying. So with a market order, the good news is that you are selling, when you're selling, you get to sell at the highest available bid. And if you're buying, you only have to pay the lowest available ask. But with a market order, the bad news is that the highest bid is below the lowest ask. So when you buy, you have to pay more than you would get if you were selling. Recall that with a limit order, the person who submitted the order specifies the amount that they are willing to trade at that specific price. Thus, since the bid and the best bid and the best ask are limit orders, there are a number of shares or units of the security that the dealers are willing to trade at each of those price points. The total number of shares at each price point is called the depth at that price. Note that the depth can be comprised of a single bid or offer from a single dealer or multiple bids or offers from multiple dealers. For most trades, the number of units of the security people want to buy or sell is smaller than the depth at the highest bid and the lowest ask. In these cases, if you submit a market order, your whole order will get transacted at the highest bid or the lowest ask, depending on whether you're buying or selling. But if you want to trade quantities bigger than those being offered at the highest bid and the lowest ask, then your order will get filled at multiple prices. So for example, let's say that you want to buy 20,000 shares of Sleesco. The two lowest ask prices are $20 and $20.10. Whoever is willing to sell at $20 is only willing to sell 15,000 shares. The person willing to sell at $20.10 is willing to sell 30,000 shares. Of your 20,000 shares, you will have to pay $20 for 15,000 shares, which wipes out the lowest ask, and $20.10 for the remaining 5,000 shares, which reduces the shares offered at $20.10 from 30,000 to 25,000. Okay, so therefore, on average, what you're going to be paying per share is going to be 15/20 times $20 plus 5/20 times $20.10. That comes out to $20.025 or 2.5 cents. Given this context, what is liquidity? Liquidity is immediacy. If you want to buy now, you'll place a market order, and you will have to pay what the limit order sellers are willing to take, and that's going to be above the fundamental value of the security. And if you want to sell now, you have to sell it for what the limit order buyers are willing to pay, and that's below the fundamental value. A good way to think about the difference between the bids and the asks is that it compensates the dealers who are placing limits for providing liquidity. They're allowing people to get immediacy. They get paid to provide immediacy by being able to sell above the fundamental value and buy below the fundamental value. From the perspective of someone demanding immediacy, the more they have to pay above the fundamental value, the less liquid the security. And the farther below the fundamental value they get to sell it for, also the less liquidity for that security. Again, from the perspective of somebody demanding immediacy, the liquidity cost is the size of the difference between the transaction price and the fundamental value. It is half the effective bid-ask spread. The effective bid-ask spread is, for a given quantity, the difference between what you would pay to get that quantity versus what you could sell that quantity for. Going back to the Sleezco example, recall that if you wanted to buy 20,000 shares, you would pay what? $20.02 per share on average. That's $15,000 at $20. 15,000 units at $20 and 5,000 units at the ask price of $20.10. Now, if the highest bid in the market for Sleezco was $19.75 for 40,000 shares, then the effective spread for Sleezco would be the price that you would pay to buy 20,000 shares, that's $20.02, minus the price that you could sell 20,000 shares for, that's $19.75. So the effective spread is essentially what? It's 25.25 cents. If there was not much depth below the best bid, then a larger market sell order would transact at an average price below the best bid. Similarly, a larger market buy order would pay an average price above the best ask. The less depth, the worse the execution. The main point is that the spread between the best bid and the best ask is not a true indication of the liquidity cost for larger orders, unless there is significant depth at the best bid and the best ask. If there's not significant depth there, then each of those types of orders, a buy or a sell order, is going to push the price up through the limit order book. Thus, a liquid market is where there are lots of dealers willing to buy at the highest bid and lots of dealers willing to sell at the lowest ask. And there's only a small difference between those two bids and asks. So that makes that a very liquid market. You can trade large quantities without moving the price around much. Okay, now let's see what determines whether the spread is wide or narrow, whether it's liquid or illiquid. There can be a fairly large variation, by the way, in liquidity over a variety of different securities. Large household names like Procter & Gamble and Microsoft have very small bid-ask spreads, while other securities that are less frequently traded have little depth and have a fairly large bid-ask spread. So what explains the difference in these cases? Since there are multiple dealers that compete with each other, the spread can be thought of as the competitive price of liquidity. Competition should drive the price of liquidity down to the cost of supplying it. So financial economists have divided the spread into two main logical components based upon the source of the cost to dealers supplying liquidity. These two types of costs are the following. One is fundamental risk. The second one is adverse selection. So let's look at each in turn. Fundamental risk is the risk that the fundamental value of the security will change significantly at any moment in time. This represents a risk to the dealer because they make money by buying low at the bid and selling high at the ask. Let's see how changes in fundamental value would affect the profits that they make. To see this, consider what happens if the fundamental value at first doesn't change much. And then we'll compare that to a situation in which the fundamental value does change significantly. If the fundamental value does not change frequently, then the dealer will be able to buy many shares at the lower bid and sell many shares at the higher ask, making the spread on each pair of shares sold and bought. For example, let's say that a sell order for 100 shares arrives now. The dealer buys 100 shares at his bid. But a few minutes later, a new market order to buy 100 shares arrives. The dealer will then sell the 100 shares he just bought at the higher ask price, making the spread on those 100 shares. And this happens over and over and over again. If buy and sell market orders arrive at the same rate over time, and there is no revision in the value of the security, then the dealer will just continue to make the spread for each pair of shares traded. In this case, the costs are low, and we would expect that the spreads, which compensate the dealers, would also be very low. Now consider what happens if the fundamental value changes frequently. In that case, the dealer has a significant probability of losing money on any one transaction. So let's revisit the previous example. The initial sell order for 100 shares comes in at, say, 10:29 a.m. in the morning, and the dealer fills that order by buying the shares at the bid. But before the next order can arrive, news that the firm is being sued for selling products that harm customers comes out at, say, 10:30 a.m. The fundamental value of the firm is going to fall, and most of the orders are sell, sell, sell. The new competitive ask price will be much lower than the prior bid the dealer just paid when filling the previous sell order. Thus, the dealer loses money on this transaction. Now notice that the dealer also faces risk if there's really good news that comes out. If the initial order had been to buy, the dealer would have just had to finance a short position and then face the risk that good news would come out about the firms, thus raising the competitive ask price above the prior bid price, generating a loss for him on that short position. So it's completely symmetric whether it's good news or bad news. Changes in fundamental value can end up eating into a dealer's profit. So the greater the volatility of the underlying security's value, the greater is the chance that the dealer will have a market move against him, and he will lose money. So the greater the volatility of the underlying security's value, the greater the risks to the dealer, and the greater the spread has to be to compensate the dealer for bearing that risk. Okay, so next, let's move on to adverse selection. Adverse selection is the risk faced by a dealer that the traders will systematically select trades that are adverse to the dealer. Adverse selection occurs when traders have superior information about the value of the security. To see how adverse selection works with securities and how it affects liquidity, consider what would happen to a dealer if the only traders active in the market were those that had superior information about that security's value. How much would the dealer make by providing liquidity in quoting bid-ask prices? All right, well, to see this, put yourself into the dealer's position. What bid-ask spread would you quote? Let's say you think that the fundamental value is $20, and you, the only dealer present in the market, set a bid-ask spread for $19 and $21. That, by the way, is a huge spread. If the only traders that are present in the market are those that have superior information, then what's going to happen in this case? Well, in this case, at best, you're not going to make any money, but alternatively, you could end up losing a lot, even though your spread is very large. So why is that? Okay, so there are two possible logical cases here. The first case is when the traders with the superior information think that the fundamental value is between your bid and ask. While you think it's 20, they might think it's $20.50 or $19.50. Either way, they will not trade with you. Your spread is too wide. The second case is when the trader with superior information thinks that the fundamental value is outside your bid-ask. While you think the fundamental value is 20, they might think it's 22 or 18. For both of those values, they will want to trade with you. If they know the value is 18, they will want to sell to you at your, $19 bid. And what's going to happen? You're going to lose $1. And if they think it's worth 22, they will buy from you at your $21 ask. Again, you're going to lose $1. So you might respond by widening the spread, say to $15 for the bid and $25 for the ask. This is a gigantic spread. This lowers the chance of you losing. If the probability that an informed investor knows that the true price is greater than 21 or less than 19 is, say, 10%, then the probability that the true value is above 25 or below 15 will be even less. So by widening the spread, the dealer reduces the amount of losses from adverse selection. But informed traders are not the only traders present in the market. There are also traders that do not have special information. People who just want to buy the security to get a return from bearing the risk, but sometimes they maybe want to sell shares in order to buy a new car. All right, so to contrast those traders with informed traders, I will simply call them uninformed traders. They are uninformed only in the sense that they do not impose any adverse selection on the liquidity providers. If the dealer widens the spread to control adverse selection, then these uninformed traders are likely not to buy the shares in the first place. And if they don't buy shares in the first place, the dealer will not have any uninformed traders to provide liquidity to. And this is how the dealers make the money, by providing liquidity to uninformed traders. So dealers have a balancing act. They cannot set the spread so wide as to eliminate adverse selection, since if they did, they would also eliminate uninformed trades, which is why they're there in the first place. So dealers set the spread so as to balance the benefit of reducing adverse selection against the cost of lost uninformed trade volume. If there's lots of uninformed volume for a security, then the dealer can make more off the uninformed trades to compensate themselves for the possibility of adverse selection. With there being much more volume, they can make the spread more frequently on many more people. Thus, if there's lots of uninformed volume, the spreads can be narrower, and if the spreads are narrower, there's going to be lots of uninformed volume, because this is a very liquid security. So there's some sense in which liquidity begets more liquidity. Okay, so in summary, we have two costs, fundamental risk and adverse selection. The bigger any of these costs are, the bigger the competitive spreads must be. Thus, securities with more fundamental risk have wider spreads. Securities with lots of adverse selection have a wider spread. The securities with most adverse selection and the widest spreads are those securities that are not traded by many uninformed investors. The stocks of small companies are just like this. Okay, so now, as argued earlier, the liquidity cost of a security cannot be measured solely by the difference between the best bid and the best ask. Of course, if the spread is really wide, that security is not liquid. But at any moment in time, this spread may be narrow, but there may be very little depth at these quotes. In this case, a sizable market order to sell will push the price way down, and a sizable market order to buy will push the price way up. What we need is a measure of liquidity of an individual security that incorporates this issue of depth. A measure developed by Yakov Amahud, referred to as the Amahud measure, does just that. The Amahud measure is the average of the absolute value of the daily price changes divided by the dollar volume in that day. Note that this is really an illiquidity measure, since the higher value of this measure indicates an illiquid market, or one in which the prices change a lot for a given amount of trade volume. This measure is calculated as follows. 1. For every trade day in a month, take the absolute value of the price change that day divided by the dollar amount of trade in that security for that day. Then 2. Take these values and average them over the 20 or so trading days in the month. So what you get is you get a monthly Amahud measure for that month. Now, what academic research has shown is that the Amahud measure varies significantly across securities. It also shows that the less liquid a security is, the higher its return on average. Now, this makes sense in that, as we discussed before, liquidity costs will erode your return. Thus, investors appear to be willing to pay less for less liquid securities than more liquid securities. This lowering of the price for less liquid securities generates a higher return. You can think of this effect that liquidity costs have on the return as being the amount the average person needs to be compensated in extra return in order to compensate for the average amount of liquidity costs they incur given the average length of time they intend to hold the security. Now let's think about it for you for a second. If you intend to hold the security for longer than the average investor, then the return per period is more than enough to compensate you for the liquidity costs that you will incur. But if you intend to hold for a shorter period of time, the extra return will likely be insufficient. Okay, so in this lecture, we've explored liquidity. We have seen how to measure liquidity, and we have noted that studies show that there's a significant variation in liquidity across the various securities in the market as captured by the Amahud measure. We've seen that the liquidity of a security depends upon the amount of fundamental risk and the amount of adverse selection, and the volume of uninformed trade. We've also seen there's a cost of liquidity. For less liquid securities, they pay a premium. Thus, if you only transacted in liquid securities, holding everything else like beta constant, you will have a lower return on average. This is true because less liquid securities compensate you for their illiquidity with a return premium, while liquid securities do not. Whether you are willing to pay the liquidity cost associated with lower returns on liquid securities depends upon how frequently you intend to trade. If you rely on a steady stream of cash flow from periodic liquidations, then it is probably worth the cost to hold liquid securities.